In a surprising development, Cathie Wood's RK Investment Management recently made a notable investment in General Motors, GM, which has taken many by surprise, especially considering Wood's prior stance. This shift in opinion regarding GM, alongside the ongoing challenges faced by Ford, is drawing significant attention. The success or failure of Wood's position in GM is expected to have a lasting impact on how the automotive industry is perceived in the coming years. In this video, we'll delve into why Wood's prediction is so noteworthy, what it means for the broader auto industry, and how Tesla's recent price cuts fit into the broader picture. Before we dive deeper, make sure to like and subscribe to our channel and hit the notification bell to stay updated with our latest content. Cathie Wood predicts that Tesla's stock price could skyrocket to an extraordinary $3,000 per share by 2025. This forecast is nothing short of remarkable, highlighting the potential struggles that traditional automakers, such as GM and Ford, might face as they attempt to compete with more innovative companies. Wood's prediction stands in stark contrast to other analysts, like David Whiston of Morningstar, who recently set a fair value estimate of $68 for GM stock. Whiston's outlook reflects a more conservative approach compared to Wood's aggressive projection. Ford's recent difficulties have also become a topic of discussion. In a recent interview with Sandy Munro, Ford's CEO Jim Farley acknowledged that the company had fallen behind in the electric vehicle (EV) sector. Farley admitted that Ford had strayed from the visions set by its founder, Henry Ford, who revolutionized the auto industry by creating an affordable car for the masses. Looking at the rapidly growing EV market, especially in China, Farley emphasized that success in this space requires a broad range of offerings, not just high-end models. This insight was underscored by his comments on how Toyota surged to the top of the market by producing vehicles that people actually wanted, whereas GM's market share plummeted from 60% to nearly zero. Farley's strategy for Ford going forward involves focusing on more affordable, accessible products, particularly in markets where the company has deep knowledge and understanding of customer needs. One example of this is the company's recent focus on pickup trucks with models like the Ford Maverick. While Ford is currently in second place behind Tesla with a mere 6.2% share of the EV market, Farley expressed pride in the company's 95 electric advances, which demonstrate the company's efforts to adapt to the evolving landscape of the auto industry. In a surprising move, Cathie Wood's RK Investment Management purchased over 150,000 shares of GM, a significant investment for its autonomous technology and robotics fund, also known as ARKQ. If you're not familiar with ARKQ, it's an actively managed exchange-traded fund, ETF, that provides investors exposure to emerging sectors, such as autonomous vehicles, robotics, and other forms of automation technology. This fund is specifically designed to capitalize on the growing demand for autonomous systems, including self-driving cars, drones, and robots. RKQ's investment approach blends both top-down and bottom-up strategies. The managers of this fund conduct thorough research into the macroeconomic trends and technological advancements likely to shape the autonomous technology and robotics markets in the years ahead. Additionally, they carry out detailed company-specific analyses to identify the best investment opportunities within these markets. The fund's managers take concentrated positions in companies they believe have the potential for massive growth, which can result in a highly volatile but promising investment option. This investment in GM is particularly interesting because it signals that even high-growth, tech-focused investment firms like ARK recognize the potential in legacy automakers, particularly in the realms of electric vehicles and autonomous technologies. The investment also reflects GM's efforts in transitioning towards EVs and autonomous technologies, both of which are critical to the company's future. This move is viewed as a positive indicator for the broader automotive industry, suggesting that traditional car manufacturers can successfully adapt to the changing landscape and remain competitive, especially in fields such as EVs and self-driving technology. Tesla's recent price cuts have also been a major topic of discussion. However, according to Cathie Wood, these price reductions are not a threat to Tesla's brand, but rather a challenge for other automakers trying to keep up. Tesla's cost leadership and its cutting-edge battery technology are allowing the company to reduce prices while maintaining profitability. This puts pressure on traditional automakers, who must adapt to these new technologies if they want to stay competitive. Tesla's pricing strategy has been a key part of its success. The launch of the Model 3, for example, was accompanied by a significant price reduction compared to previous models, making it accessible to a wider range of customers. This move helped Tesla build a massive pre-order base, which solidified its position in the electric vehicle market. Additionally, Tesla's decision to lower the price of its Model S earlier this year sparked concerns among some analysts, who feared it could negatively affect the company's brand value and profit margins. However, Tesla supporters argue that the company's economies of scale, efficient production processes, and strong cost leadership will allow it to continue to maintain healthy margins while offering lower prices. By reducing its prices, Tesla is effectively expanding its customer base and increasing its market share, which, in turn, boosts its economies of scale and further strengthens its competitive edge. This enables the company to reinvest in research and development, which is essential for sustaining innovation in the highly competitive electric vehicle sector. Some critics, however, are concerned that this strategy might erode Tesla's luxury image, given that the brand has been associated with exclusivity. There are also concerns that the ability to maintain lower prices might be limited by rising costs in the supply chain or battery production. While Tesla supporters argue that the company can maintain its profit margins despite price cuts, there are broader concerns regarding the ability of legacy automakers to keep up. Traditional manufacturers have been slow to embrace the shift towards EVs, and Tesla's aggressive investment in EV technology has given it a significant advantage. In contrast, many legacy car companies have continued to focus on gas-powered vehicles, putting them at a disadvantage in a rapidly changing industry. The slow adoption of electric vehicles among traditional automakers is due to the automotive industry's highly capital-intensive nature. Long-standing relationships with suppliers and dealers make it difficult and expensive for these companies to change their business models. Additionally, the high costs associated with EV battery technology and the lack of charging infrastructure have also been significant barriers to entry. However, with consumer demand for EVs growing rapidly, these companies are starting to shift their focus and make more substantial investments in electric vehicle development. Many have announced plans to release new electric models and phase out gas-powered cars in the coming years, signaling that they are acknowledging the need for change. While legacy automakers still have significant ground to make up in terms of innovation, they are beginning to understand the necessity of embracing new technologies to stay competitive. Newer players, such as Tesla, Rivian, and Lucid Motors, are disrupting the traditional automotive landscape, forcing established companies to adapt or risk losing market share. Additionally, legacy automakers are facing increasing regulatory pressure as governments worldwide introduce stricter emissions regulations, which further encourages investment in EVs. In conclusion, the automotive industry is undergoing a profound transformation. Legacy automakers must invest heavily in new technologies and adapt their business models to remain competitive. The pressure from new market entrants, regulatory changes, and shifting consumer preferences will require significant changes to supply chains, manufacturing processes, and marketing strategies. Only time will tell which companies are best positioned to thrive in this new era of automotive innovation. Thank you for watching our video. If you enjoyed it, give it a thumbs up and don't forget to subscribe to our channel for more updates on Tesla and the evolving automotive landscape.